Hi, welcome to another episode of Financially Speaking with SFM. I'm Daniel Courson, a wealth advisor, here now 15 years. We've gotten a lot of questions this week regarding the recent banking crisis. Have called in asking if they should be concerned about their own bank. So Silicon Valley Bank and Signature Bank, along with Silverstar, are all very unique banks. The clientele, the depositors, are predominantly venture capitalists and tech startups. So tech companies are the most sensitive of any companies when it comes to higher interest rates. Interest rates spike, tech companies borrow less to fund future projects. So when a bank gets deposits, ordinarily they turn around and make loans with those deposits. But during the pandemic, there weren't really many loans to give. So what they did was invested that money into 30-year treasury bonds. Well, when interest rates spike, the farther out in duration you go, the lower the price drops. So 30-year treasury bonds lost at least 30% last year. It was the worst asset class in the market. And so a lot of their depositors needed to withdraw some money. And therefore, the banks had to sell these bonds prior to maturity, meaning that they took on realized losses. So these losses went into the billions. So if enough of these depositors was taking money out of the bank, and then the bank was selling at massive losses, they had a liquidity issue. And then word got out. One depositor spread news to other depositors, and that's essentially what creates a bank run. Secondly, all three of these banks are what you call crypto-friendly banks. I know that Signature Bank and Silverstar Bank had at least 20-25% of its assets in cryptocurrency, which is already a high-risk asset. So your typical bank that you may have of the major banks or maybe your local credit union, they are not dealing with tech startups, venture capitalists. The average account size is not 4 million, and they're not dealing with a lot of cryptocurrency. So there is a difference. I want to ease some fears just by getting that out of the way. So why did this happen? In its simplest form, banks get their deposits from clients, which are both individuals and corporations, and they pay those clients a short-term interest rate. They then invest some of those deposits in fixed income securities like U.S. Treasuries or mortgage-backed securities. Like many investors' fixed income portfolios, some banks experienced substantial market declines during 2022. So with a smaller fixed income portfolio, they have less money to pay or repay their depositors. If one depositor wants to withdraw their money, it's not really a problem. But if enough depositors want to withdraw their money, you have a bank run. In the case of SVB, run risk was higher given the depositor concentration with venture capital-backed companies. The intersection of these risks can result in liquidity risk, which is at the core of the issue today. How did the government act? The government acted quickly to bolster confidence in the banking system. Key actions over the weekend including first, protecting depositors. The Treasury pledged to fully protect all Silicon Valley Bank and Signature Bank deposits. This will help minimize the impact on SVB's technology-heavy client base, and it also should help reassure depositors of other banks as well. Second, ensuring bank liquidity. The Fed is creating a program to support other banks in similar situation to SVB. The bank funding program will offer loans to banks and treat all collateral at 100% of its face value. For example, if a treasury bond was purchased for $100 and is declined in price to $90, the Fed will treat the bond's value at $100 for collateral purposes. This temporarily eliminates the fixed income portfolio loss issue discussed earlier. Importantly, the fund is designed to be large enough to protect all uninsured deposits in the wider U.S. banking system. Last question, what should I do or what should you do? This is not the global financial crisis. Banks are better capitalized. The government has learned a lot of hard lessons on how to handle bank failures, and the root causes of the day's issues are very different. Promoting financial stability is one of the Fed's core functions, in addition to its dual mandate of price stability and full employment. As such, we expect the Fed to be more cautious in future rate hikes, potentially leading to a more stable rate environment. In every economic cycle and every market cycle, there are risks and there are opportunities. Last week reminded us that some risks can spiral out of control if they are not contained. Thankfully, quick action from the Fed, Treasury, and FDIC substantially reduced the risk of a financial crisis. But risks remain, and today's risks are tomorrow's opportunities. Perhaps that's the nature of market cycles. Just as we encourage investors to stay invested through recessions and bear markets, we encourage investors to remain disciplined in their long-term investment plans. Thank you, and I hope you enjoyed today's episode, gained some clarity on the recent events. If you have additional questions on this topic or topics that you may want me to discuss at a future video, just give me a call or email, and I'll be happy to add those. Thanks, and have a great day.